Hello, in this video, I'm going to give you additional instructions for writing your portfolio summaries. So by now, before looking at this, you should have read the instructions, and you should already have, you've obviously, to this date, you should have already uploaded your portfolios for the portfolio contest. So as I mentioned earlier, it's kind of backwards in a way for this class. I want you to have enough time to see a trend in your portfolios, at least a 2-month trend if possible. So that's why you make up your portfolios fairly early before you really have all the knowledge to analyze them. So once you write up your portfolio summaries and once you do your analysis, you may change your mind about picking the stock, which is perfectly fine. So at the end of your portfolio, you may say, at the time, I thought this was a good stock, but after doing my analysis, it looks like it's overvalued. So I may still be a buyer for this stock, but not until the price comes down or unless the price comes down. So it's perfectly fine to change your mind. Or you might say, after doing my research, I decided the stock is not a good buy. So that's perfectly fine. Anyway, so when you look at the instructions regarding the portfolios, there's 3 suggested top areas. All right, so let me show you this thing that I wrote here. Okay, so these are the 3 sections that you're going to be writing about when you do the portfolio analysis. The first section is the economic summary or economic analysis. The second section is the fundamentals. The fundamentals basically consists of looking at the ratios and also looking at comparing the expected return to the required return. And so the required return is that formula that is in chapter 9, where you're calculating the required return based on your risk, which is, I think in this book they use K, but it's K or R. So K or R, which is the required return for the risk, equals the risk-free rate, which you can just make up that number, just assume that's 3%. That's what the rate you could get on a bond, risk-free. 3% is actually a little high in this environment, but just go with the 3%. The return on the market, I would just go with 12%. That's what they think the market's going to return. So what you can do is go into Yahoo, which I'm going to show you a little bit later, get the beta for each one of your stocks and calculate the required return using this formula: risk-free rate plus the market return minus the risk-free rate times beta. That'll give you the required return, the amount that you should be requiring for your stock based on the risk. Now, then you're going to compare that with the expected return. The expected return, I'm going to show you how, that's what these so-called experts think that stock is going to return for the year. I'm going to show you how to get that in Yahoo. All right, so part 1, economic analysis, which I'm going to talk about in more detail in a minute. Part 2, fundamentals. And then that includes the ratios and that you can find in Yahoo, and this comparing the expected return to the required return. And then part 3 is the technical analysis. Now, if you look at part 3 of the textbook, that's where all this information is for the most part. So that if you want to do a ratio for the ratio analysis and so forth, that's chapters 8, 9, and 10. Chapter 11 is the macroeconomic analysis, gives you some ideas of what you could look at, what kind of macroeconomic indicators might be affecting a particular industry or the firms that you're looking at. And then the technicals are in chapter 12. That talks about technical analysis. So in addition to the chapters, though, in this video, I'm going to give you more specifics on how to do the fundamentals, what to look for, and I'm going to give you more specific instructions on the technical analysis. Okay, so let's start first with the very beginning of your report and the economic analysis. So I'm going to take this paper away now. Hopefully that's coming through to where you can read it and it's not backwards or some crazy thing. But anyway, economic analysis, fundamentals, and technical analysis. fundamentals, meaning looking at ratios, comparing the expected return to the required return. Okay, so when you go into Moodle, you'll see a couple of examples. I've got some examples from an online class that was a Nichols online class from last year. They didn't do the technical analysis in those samples. So I also added some samples from fall of 2018, which was a class just like you're taking, where they included the technical analysis, so you can get an idea of what it will look like. So when you do these summaries, you'll see in the samples, there's usually a sentence or two about the history of the company, how, just a couple sentences about the company and its history, blah, blah, blah. You don't have to include that if you don't want to. That's optional. So, but what you want to, in that first paragraph, you basically want to be thinking about the big picture. So just think about how is what's going on in the economy today, the geopolitical issues, regulation, just any macro factor. How is that affecting that particular stock? And how is that affecting the industry that it's in? And so again, it's just a big picture type of situation. So as of the publication of this video, this is July 8th, 2021. We're coming out of COVID. So everything's looking pretty good, pretty rosy as far as economic analysis. So for most of your stocks, the growth looks good, unemployment is down, the economy is rebounding. They're talking about, economists are saying we're having unprecedented growth as people are actually, the latest stats that I've been reading are saying that people are coming out of COVID with more money than before. People are richer than before COVID. How is this possible? Well, number one, they got all this COVID money. Number two, people didn't go anywhere for almost a whole year, and they didn't go out. They didn't spend money for almost a whole year, so they have a lot of savings. Number three, they've paid down debt. All that and number four is people have made a lot of money in the stock market, because the market's been up quite a bit. So you've got all these factors that are pointing towards a really robust recovery from COVID. So just, you can talk about those issues. And then you can talk more about specifics. For example, if you have, let's see, let me just pick, I'm just trying to think of a few companies. Caterpillar. So let's say you picked Caterpillar or US Concrete. Any company that's into building or, in the building industry at all. If you think about coming off of COVID, and mainly with the Biden administration, not so much COVID, but with the Biden administration, and this was somewhat true with the Trump administration also, we have, there's going to be increased infrastructure spending. The infrastructure in this country is antiquated, and so there's a lot of infrastructure spending. So that's going to help companies in the building industry. So that's one example. If you have a cruise line, the cruise lines have really got hit during COVID. They should be coming back because people are out and about. People want to go on cruises. So anything that deals with tourism, leisure, that would be a rosy outlook because of COVID. People are being forced to go back to work. Companies are actually getting fed up with people wanting to stay home, and they're saying, you got to go back to work by such and such date, or you're going to be fired. So people are buying clothes. So the retail sector is looking good. If you have any retail stocks, people are having to buy clothes for work, and people are buying back to school clothes because now all the kids are going back to school. Another interesting take. If you pick Sephora or Ulta, those are cosmetic companies. Women are having to wear makeup again. They're buying lipstick for the first time in a year. So you see what I'm getting at. So just think about what are some trends. Let me think of some other things. Disney's another one that may be undervalued. They're off of their highs as people go back to the theme parks. So what are some negatives? Well, if interest rates are a negative. So right now, interest rates are low. That's fueling the markets, because when interest rates are low, it makes companies' cost of capital lower, so they're going to expand. As interest rates increase, that's going to cause the economy to slow down a bit. And so increasing interest rates is going to affect the housing market. And that will trickle down maybe to Lowe's and Home Depot, anything that new home buyers would spend money on, that's going to that's kind of soften the market in those areas. Also, think about all the stocks that went up during COVID. And if you have any of those stocks, there may be some issues now that we're coming off of COVID. So for example, a lot of the athletic apparel companies, Lululemon, Athleta, they did very well during COVID. All those stay-at-home stocks that did well during COVID are not doing as well now and probably will go lower. Campbell's Soup, Smucker's, Lowe's and Home Depot did very well during COVID because people were staying at home, so they were doing home improvements. So anyway, so those are just some ideas when you're thinking about the big picture. Just read a few articles about your stocks, and before you know it, you'll have more than enough information to talk about, to discuss some of the things I'm talking about regarding what the forecast is, for these stocks and for this particular industry, for a particular industry. As I mentioned in the previous video about the assignment, Seeking Alpha, I think I mentioned this in the last video, SEEKING Alpha, ALPHA. Seeking Alpha is a really good website I like to use. You have to register, but it's free. And I'll just click on a stock that I'm interested in and then go to the news articles. And they'll have these analysts that have pretty much done the work for you. They'll discuss if they're what they think of the stock, and within those articles you can see a lot of information about the economic environment. Now, when you go into Moodle, you're going to see Mergent and S&P Capital up there in the top section. Those are two links for software. Those are software programs that we have through the Nichols Library. If you're a finance major, you'll be using these again in other classes. But Mergent, you can find individual information about companies in Mergent, the financials and news and so forth. And then S&P Capital is another subscription that we have. The S&P Capital is actually better than Mergent, but you can get articles and information through them as well. Okay, so let me know if you have any questions on the big picture economic analysis, but that's kind of what I'm looking for there. So that's the first paragraph. Okay, the second paragraph is the fundamentals. So there you're just looking at some key ratios and looking at, as I mentioned, at the required return versus the expected return. You can use Mergent, you can use S&P Capital for those. You don't have to calculate all these ratios for this class. I'm perfectly fine with you getting them from these various websites. You might just want to use Yahoo. Yahoo Finance is good for this. So I'm going to share my screen and we're going to go into Yahoo Finance and I will attempt to do that, and I'll show you how you can, where you can access these. Okay, so you get into Yahoo Finance and you just pull up a ticker here. I'm going to pull up Disney. All right, so this is you probably have already looked at Yahoo Finance, but if you haven't, let me just show you where some things are. So this is the summary page. So this tells us where Disney is right now. They're 42 cents down today. This is the previous close. This is where it opened. This is the range for the day. This is the range for the year. This is the volume. Here's the beta, okay? Okay, this company does not have a PE ratio. I don't know why they don't have, typically they don't have a PE ratio because they've lost money. That's why. So, you know, this is kind of unusual for Disney. Their earnings per share is negative. So they've had, their income is, they've had a loss because of COVID. So they're not going to have a PE ratio. But anyway, their beta is 1.2. They're not paying a dividend right now. But here is their target price is so they're at 172 and their 1 year target is $206.97. So this is basically what this is. This is an average of what these analysts think the price is going to be. So if you go over here to analysis, you can find, it'll show you, excuse me, what all the analysts have valued this company at. And the range will be, well, let me just try to find it here. So here, let me see here. Okay, here it is. So there are 26 analysts who have valued the stock. And so like I was saying in chapter, what was it? Chapter 10, I think it was. Chapter 9 and chapter 10. Chapter 9, the valuation of common stock. These valuations are, of course, it's not an exact science. It's based on historical information and assumptions. And so you can see how much these vary. So this is the current price where it is. The lowest, the most pessimistic expert has valued Disney at 147. The most optimistic expert has valued it at 230. So what we saw on the summary page was 206.97. That's what the average is. All right, so what you can do is, first let me talk about comparing the required return to the expected return. Okay, so let's go back to the summary page, right? And let's calculate the required return for Disney. Okay, so I'm going to use that formula of K or R, the required return. So the required return is going to equal the risk-free rate of 3%, okay, plus the market return that I'm assuming is 12%, minus 3% times the beta of 1.2, okay? So I'm going to take, you see Disney's beta, so I'm going to take 1.2 times 9, the 12% minus 3%, so 1.2 times 9 plus the risk-free rate of 3. And I get a required return of 13.8% for Disney. All right, now I'm going to calculate the expected return. The expected return is the percentage return from where it's trading now to its target price, plus whatever the dividend yield is. That's going to be my total expected return. And they don't have a dividend yield for Disney. So all we're going to do is find the percentage change here between what this average target is to what it's trading for today. Okay, so let's see here. So we're going to take, so remember to calculate the percentage increase, you take you're going to take the target price minus the original price if you purchased it today. So it's going to be 206.97 minus 172.52 divided by 172.52. So that would give us, let's see what that is. So I'm just going to round up. I'm going to take $207 minus, I'm just going to make this 173 minus 173 is $34. So that's it. So they're expecting a $34 increase divided by 173. That's 19.6%. Now let's say that the dividend yield was 1%. I would just add that to the total return and it would make my expected return 20.6%. Okay, so what did I do here? I just calculated the expected return, and the expected return, if it goes up to this 1 year target, is 19.6%. So my expected return is 19.6% on Disney. My required return on Disney is 13.8%. So based on this, Disney's undervalued, right? Because I'm requiring a return of only 13.8% to be compensated for my risk, but they're expecting Disney to return 19.6%. So Disney's undervalued. Okay, so don't pay attention to this. They're saying it's overvalued here. I don't believe that. This can be all over the place and it's not updated. Now, are we correct? You know, maybe, maybe not. So if we went, you know, by the most optimistic, you know, this is just the average. So anyway, this is just one estimate. But based on this estimate, what you can say is in your report, you can compare the required return to the expected return and say, based on this, Disney's undervalued and would be a buy. Okay, so that's how you do that. And then let's take a look at some of the ratios. So you come over here to statistics. And let's see here. Okay, here's the return on assets. Here's the return on equity. So here's some of the main ratios that you can look at. You should include the PE ratio. If the company doesn't have negative earnings, they'll have a PE ratio. So you should talk about the PE ratio, talk about the return on assets, the return on equity, the net profit margin. You can look at the current ratio. Here's the debt to equity ratio. So they've got, let's see. So this is, they have pretty low debt because the debt to equity margin is only 56. Let's see here. Okay, so let me just give you some of the main ratios to look at, just to repeat. Definitely look at the PE ratio, look at return on assets, return on equity, and let's see. You can look at the revenue growth. I mean, that's not a ratio, but you can look at that. Take a look at their current ratio. And those are fine. So PE, return on assets, return on equity, current ratio, maybe look at the debt to equity, and you can look at the net income, some of their profitability ratios. Oh, here, this is what I was looking for, profit margin. So take a look at their profit margin also. And then take a look, so look at some of those key ratios, or look at those key ratios, and then it's hard to find industry averages. So just look at, for your companies, just look at a couple of their competitors. So pull up some of their competitors, go to the summary sheet, go to the statistics, and just look at those ratios just to do a quick comparison. And that's it. So just to repeat on the fundamentals, you're going to look at compare the required return to the expected return, look at some key ratios, compare those to the competitors, and then also forgot one thing, take a look at the PEG ratio. That is, let me see, that's in stats, I think. Here it is. Okay, so look at their PEG ratio. Look, so this is confirming to me that Disney's undervalued for their growth. So you take the PE ratio compared to their growth. And so look at what their PE ratio, look at what their PEG ratio has been, okay? And look at what it is now. So here is further confirmation to me that Disney may be undervalued. So take a look at the PEG ratios too, definitely. Okay, so just to sum up the fundamentals, key ratios, compare them to competitors, look at the PEG ratio, and compare the expected return to the required return. Okay, now you may find that a lot of your stocks are overvalued because the market keeps, unless we have a correction in the next few weeks, for most of your stocks, they're going to probably be overvalued because the market keeps making these record highs. And so you might have a situation when you get to the end of your summaries where you just say, hey, this is a good company, but it's a little pricey right now. So I would be recommending buying this after a dip or at a certain price. Okay, I'm going to try to find a stock that pays a dividend so we can do one more calculation of the expected return versus the required return. So I can show you, just show you an example with a company that pays a dividend. Okay, I know ExxonMobil pays a dividend, so let's take a look at that, at ExxonMobil. Okay, so let's calculate the required return for ExxonMobil. All right, ExxonMobil's beta is 1.42. It used to be much lower, so that's kind of interesting. All right, so let's calculate the required return for ExxonMobil. That's going to be 3. Remember, I'm assuming a 3% risk-free rate and a 12% return in the market. So it's going to be 3% plus 12% minus 3% times 1.42, which is the beta. And that is, okay, so we've got 1.42 times 9 plus 3 is 15.78%. So that's my required return, 15.78%. Now let's figure out the expected return. The expected return is going to be the percentage gain from $60 to $66 plus the dividend. Now they're paying a 5.76% dividend. So this is their dividend yield. So let's so that's part of our total return. That's part of our expected return. Okay, so I'm going to take $66. I'm just going to, you don't have to worry about the cents. It really doesn't matter that much. So I'm going to take $66 minus $60. Okay, that's $6 divided by $60, which is what I bought it for today. So it's the year-end price minus what you paid for today, or the current price, divided by the current price. So that's a 10% return plus my dividend yield. So 10 plus 5.76, that's a 15.76 expected return. Okay, so my expected return on ExxonMobil is 15.76%. The required return is 15.78%. Okay, so that's pretty much the same there. It's fairly valued. So this is really pretty much a judgment call on your part. Personally, I think it might be undervalued because oil's been beaten down so much, and I think oil is probably going higher. So I would probably be a buyer of ExxonMobil, but if you've picked ExxonMobil, it's pretty much a judgment call. So right now it's saying that it's fairly valued. Okay, so that's an example of comparing the expected return to the required return for ExxonMobil. So if a company pays a dividend, don't forget to add that dividend yield to your expected return once you calculate the percentage change in the price. Okay, let's take a look at the stats real quick for ExxonMobil. All right, so here's their PEG ratio. Well, they're not really a growth stock, so they're not dealing with the PEG ratio. That's only really for growth stocks, so don't worry about that. Profit margin is negative. So you can compare ExxonMobil to ConocoPhillips, ticker COP, if you have ExxonMobil. Compare them to British Petroleum, BP. Those would be a few other competitors, Chevron, CVX, and just see how their ratios compare to those competitors, just to see. So there's the profit margin, there's return on assets, return on equity, and so forth. Here's the current ratio. Okay, so that's the fundamentals. Ratios, expected return to required return, and then the PEG ratio, if applicable. Okay, so that's the first 2 out of 3 down. We talked about the economic environment, we talked about the fundamentals. The last part is the technicals. Now, read chapter 12 to get an idea of what the technicals are. And then I'm going to show you some 3 specific technicals that you can look at. Now, basically what the technicals are looking at the charts. So there's a subgroup of analysts out there. I mean, any that believe in looking at the charts to try to see if a stock is undervalued or overvalued. So what I'm trying to say is, all of these are tools that we can use, trying to get the big picture, looking at the economic analysis, looking at the fundamentals, and then looking at the technicals. It's all part of trying to see if a stock is a good value or not. Now, looking at the charts is basically what they're doing is just think about the market is basically a flood of people, right? The market is just a bunch of people who are buying and selling. And if there's more buyers than sellers, the stock goes up. If there's more sellers than buyers, the stock goes down. And so what the technical analysis is looking at these different charts to see if a stock is overbought or oversold, or to see if a stock is overvalued or undervalued. So a lot of, when you read the textbooks, most academics feel that the technical analysis is not very solid. They actually, from what I've read, they say that it's all nonsense because our brains are hardwired to look at patterns, to look at charts and look at patterns and see patterns in charts and try to make stories out of these patterns, but it's really all meaningless. But here's the deal. If enough people believe in these charts, then doesn't it become a self-fulfilling prophecy? So I'm going to show you some of there's a lot of technical analysis out there. I'm going to show you some of the three main ones that are I think that are relatively easy to use, and it will help you to understand what's going on. Okay, so let's look at charts. Here it is. Okay, so we're in ExxonMobil. Let's go to the charts for ExxonMobil. So the three charts that I want to show you are the moving averages, the Bollinger Bands, and the RSI, the resistance strength indicator. Okay, so I'm sorry, RSI is the relative strength indicator, not resistance. Okay, so let me start over here. Okay, so we're going to go to these indicators. So you go to your stock and you go to chart and you go to indicators. Here's some commonly used ones. The moving average. So let's look at the 50-day moving average. So what the moving average it's just the average closing price of the stock. And so you can take a look at the 50-day moving average, the 20-day, the 100-day, the 200-day moving average. And so let's say it's the 50-day moving average. Tomorrow, they'll drop off day number 1 and they'll include day 50. And so it just changes each day. So all they're doing is adding up the last 50 closing prices and dividing by 50 to get this moving average. And this is the simple one, which it's an equally weighted moving average. They have others. This one called the exponential weights the more recent closing dates more heavily than the earlier ones. But let's just do the simple one. Okay, so let's do this. Okay, so this is how you look at the moving averages. So the idea here is that if a company is above, see how ExxonMobil here, they were above their moving average. If a company drops below their moving average, as they approach their moving average, they should bounce off of it. Okay, so here, as they approach their moving average from above, they should bounce off of the moving average. But if they go through their moving average, it's a sell signal because it means they're going to drop further. Now on the down, so this basically was a floor, was a resistance point. This is a floor here and this is a ceiling here. So then once they get below their moving average, when they're on their way up, so let's say you sold them here. If you were using the moving averages like the experts do, this here would be a sell signal because it fell through. This is a support level. It fell through its support level. All right, so you would sell here. And then here it's turned around. So now this support level has now become a resistance level. So the idea here is that it should bounce off of this. If it doesn't bounce off of this, it would be a buy signal. Okay, so this, here it worked like it was supposed to. I sold here and I'm waiting. Here it bounces off, so I don't buy. But here it broke through the support level. So once it broke through, that's a sign that it should keep going up. So once it breaks through this moving average, I should buy. And so here I've bought it and it came down here, but it bounced off. So I'm still holding it, bounced off and goes up. All right. And then right here, it just broke through here. I should have sold it here. So so just to sum this up, the whole idea of these moving averages is that they give us a sign, it can give us a sign of resistance and strength. And so if a company is coming up from below and it goes through a moving average, that's a sign that it could break through and it could be a buy signal. If it's coming from above and breaks through a moving average from above, that's a sell signal. So like I said, you can look at these and a lot of people think they're nonsense. I don't really like the technicals, but it's interesting, knowledge is power. But like I said, if enough people believe this to be true, enough of these traders who are acting on it, then it does become a self-fulfilling prophecy. So what some people will do also is they'll, in addition to the 50-day moving average, they might look at the 100-day and the 200. Because if a company breaks through its 100-day moving average and then also breaks through its 200-day moving average, that's a really negative sign if it's breaking through from the upside. Positive sign if it's coming through from the downside. So let me show you. Let's do the 200. All right, so here you see Exxon. Okay, so this is, let's see, this is the 50. Wait. Okay. The 200-day moving average is 49, the 100-day is 58, and the 50 is 63. Okay, so right now, ExxonMobil has just broken through its 50-day moving average. And so I would be waiting, if I were analyzing the technicals, I would be waiting to see what it does. If it continues to go through, if it breaks through the 100-day moving average, that's a very negative sign. If it goes all the way down here, that's a really bad sign. Or you might think this is a buy signal because it's gone down so low. The other thing that these technicals do, a lot of these people who look at the technicals, they use them as contrarians. In other words, when things reach extremes, extreme lows, it's a buy signal, or extreme highs, it's a sell signal. Okay, so anyway, these are just this is the 50, 100, and 200-day moving average. So you might look at the moving averages and, like, for example, if your company is way up here, let's say ExxonMobil were way up here, then you might say, well, based on the moving averages, it could be overvalued. It could be due for a downturn. So anyway, take these with a grain of salt, but it is interesting to look at these. So that's what the moving averages are. Right, let me get out of this now. Another one, let's pick a different company and look at something called the Bollinger Bands. So let's go to Disney. Okay, so let's go to the charts again. And the second thing I want to show you is something called the Bollinger Bands. So let's go to chart, indicators, and look at the Bollinger Bands. Okay, so the Bollinger Bands it's the moving average plus 2 standard deviations to either side. All right, so this is kind of interesting. So this is the 20-day moving average right here for Disney. Okay, so let's look and see what's gone on here with Disney. So this would have been a sell signal, and then Disney really dropped down, and then here, this was a buy signal here because it went above its, it went above its moving average. So this would have been a buy signal. And then technically this would have been a sell signal. And then see here, sell signal. And then it really can't break through its moving average. Ever since last March, Disney has not been able to break through its moving average. Well, it did right here. So anyway, there's the moving average. And so the Bollinger Bands are 2 standard deviations above and below the moving average. So the idea here is that if a company is way up here at the top of their Bollinger Band, that might be a sell signal. This is what I mean by a contrarian view, because you look at here, see these, it's gone, the price is so high above its moving average, 2 standard deviations above, that it's a sell signal. And then down here, when it gets down to the lower Bollinger Band, you see that's a buy signal. Now here's one problem. You see how as the company's price goes lower, the Bollinger Band gets wider. So that's kind of a flaw with it. And here too, it's gotten wider as it goes higher, because it's giving you a sell signal, or a buy signal, but the band is just getting wider. So that's one of the flaws that people talk about with the Bollinger Bands. But anyway, to sum this up, with the Bollinger Band, when they get to these extremes, it can be a buy signal or a sell signal. So this is signaling, here's another signal for us that Disney is undervalued, because it's almost to the lower end of its Bollinger Band. So another good signal and this is something that people like to use when they're looking at the technicals. Okay, then the last one I want to look at is the RSI. So let's look at the RSI for Disney. This is actually one of my favorite ones to look at. Now, if you want to get a better definition of these, like the Bollinger Bands, the moving averages, and the RSI from what I'm telling you, if you want to just get a different explanation, you can Google these and it'll take you to Investopedia. That's a really good website. It'll give you some really succinct definitions. Okay, so let's look at the RSI. Okay, so the RSI, let me show you something real quick. Hang on a second. I'm going to give you a better definition of the RSI than what I can think about real quickly in my head. Okay, so the RSI, here's Investopedia. It's called the relative strength indicator, right? So basically, it measures the magnitude of recent price changes. So the RSI tells us whether a stock is overbought or oversold. Okay, so this is basically what you need to know. The RSI, the relative strength indicator, ranges from 0 to 100. 50 is neutral. So if a stock if you have a reading of 30 or below, that's telling us that the stock may be undervalued. If you have a reading of, some people say 70, some people say 80, but let's see what they have here. You don't have to worry about that, but about the math. Yeah, 70 or above is considered to be overvalued. So 50 is neutral. If you're seeing an RSI that's above 70, that could tell you that the stock is overvalued, so you probably should sell it, okay? If it is 30 or below, it's telling you that the stock may be undervalued and you should be a buyer. So I like to see around 20 and 80. Those are the numbers that I use. Okay, so let's go back to Yahoo here. Okay, so we have this RSI for Disney. So let's make sure to move your cursor all the way over here and it'll tell you what it is right now. So you see on Yahoo, they're using 80 and 20. So Disney has an RSI of 41. So when we figured out the expected return and compared to the required return, that told us that Disney was undervalued, right? When we looked at the Bollinger Bands, it was telling us that Disney was undervalued, okay? But when you look at the RSI is pretty close to neutral. So Disney might be slightly undervalued, but not heavily undervalued. So that's what I'm telling you about. You have to look at all of these factors and take them into account. Okay, so anyway, it's got an RSI of 41. It's slightly undervalued, but you really want to look for extremes. So let's look at some others here. Let's look at, let's go back and put an ExxonMobil and see what we have there. Let's look at their RSI. I suspect it might be overvalued, but let's take a look at the chart and indicators and go to RSI, relative strength indicator. And you see here, overbought is 80, oversold is 20. You can change the periods, but I just usually use it at the default. This is the 14-day RSI. Let's see what it says. It's at 41, too. Okay. So let's go to another company. Let's see here. Let's take a look. Let me think of one. Let's look at one of the cruise lines. Let's look at Carnival and see what they say about Carnival. Okay, they're saying that Carnival is at 28. So the cruise lines are a bit undervalued, and so that's telling us that it's slightly undervalued. That's Carnival there. So you get the picture. Let me think of another one. Let's see. Let's take a look at Tesla, because they have been going down quite a bit. Let's see what they have. All right, so Tesla, here's the chart. And they have an RSI, oh, they're right at neutral of 52. So it might be, with the way the market is, the market's pretty valued, a lot of these stocks have a pretty lofty value, even though some of these are down. Tesla's down from like 900, but you see it still is neutral on the RSI. So you might have some difficulty. You might finding some of your stocks that are undervalued based on the RSI. So anyway, just to sum up, for the technicals, look at the Bollinger Bands, look at the moving averages, and look at the RSI, the relative strength indicator, to see what it's telling regarding your different stocks. All right, so then let me just sum up, give you some more information just to sum up. Going back to the first paragraph, your economic analysis, you're going to see, you don't have to repeat it for 10 stocks. So maybe do a kind of a longer economic analysis for the first stock or so. And then for the rest of them, you can just say, similar economic analysis as from what I said previously. However, this stock, in addition, I would also look at this such and such for this stock. So for example, let's say in your first stock, you talk about all the macro variables that I talked about earlier. The economy is rebounding, unemployment's low, people have a lot of spending money, blah, blah, blah. You talked about interest rates, but you also picked a stock that maybe infrastructure spending or regulation might be a factor for that company. So you can talk about all the general macroeconomic analyses in one of your summaries, and then for the others, just talk about additional specific ones. All right, so you don't have to repeat. All right, and then after you do all, write your 3 paragraphs, like it has been suggested, then just sum up and just tell me, in addition to all this, why are you picking this stock? And it's perfectly fine if you say, I just had a hunch about this stock because I've been reading on these different blogs about the stock, and it's popular, or I think that this is the trend. A lot of this stuff isn't rocket science. Really, the key to making money in the stock market is trying to identify a trend and capitalize on that trend before it becomes common knowledge. So if you can identify a shift in people's behavior or personal tastes or something of that nature, and get in on the ground floor of something, then that's how you can really make a lot of money in the market. So maybe you bought a lot of the stocks in your portfolio, you just bought on a hunch. And that's perfectly fine. So what I'm trying to say is, at the end of your summaries, sum up why you bought the stock, and there could be other reasons besides these 3 things. And after all your research, maybe you decide it's not such a good buy anymore. Maybe you would be a buy if the price goes lower, or you wouldn't be a buyer at all. So, okay, so anyway, hopefully this helps to narrow down your focus and tell you exactly what I'm looking for with these summaries. Okay, I hope you get a lot of, I know this project is a lot of work, but I hope that you really get some useful knowledge out of this project that will help you in your future when you're picking stocks or picking mutual funds. Yeah, I think this is really valuable information for us to have, for you and everyone to have who takes this course for the rest of your lives, as far as trying to invest wisely and responsibly. Okay, don't forget, give me a call, text, or email if you have any questions when you're working on the project. Talk to you later.